In this video, I want to talk about a stock that was flying sky high just a couple of months ago and right now has retraced by around 50+%. Now, this is a company that we've covered on this channel already twice. I still believe this is a great investment for the future and might actually open a position in the coming days. The company I'm talking about here is Transmedics. Now, Transmedics, as you can see, at one point this year, this stock was up 121%. But in the last 3 months, this stock has gone down by 56%. The previous quarter was not the greatest one, but this is a company that is still expected to grow extremely fast in the current fiscal year, in the upcoming fiscal years as well. I mean, this is a company that is still expecting to reach its goals by 2028, 10,000 transplants a year. So unless that changes, unless that midterm guidance does come down a little bit, I don't feel there are a lot of reasons of concerns. Yes, right now they're investing more in the business, they're expanding the NOP network, they're also buying more airplanes, which is of course hurting margins right now because you're buying more airplanes, there are more airplanes available, although last quarter only 10 were available operationally, so that hurts margins. But for the long run, they're thinking not months ahead, they're thinking years and years ahead. And in my opinion, they are the dominant player in their field. So the more they can invest today and still grow quite quickly, the better it will be for the future of this company. So let's discuss this a little bit further. Of course, do share your thoughts down in the comment section below as well. Like, subscribe, do all of that, we really appreciate it. And if you want to support me even further, do check out the link down in the description and end up in comments with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Let's first look at the average analyst price target. Where does that sit? Well, it sits 62, close to 63% higher than the price we're at today. Of course, since the last earnings report, that average analyst price target has come down quite significantly, but still quite a lot of upside left if you believe the analyst here. Looking at some pricing metrics, well, we don't really have that much to work with. We've got a forward PE, EV to EBITDA, price to sales. Yes, they're lower than their mean. I mean, much lower. Why is that? Well, first of all, yes, the stock has gone up in the last couple of years, but from a profitability standpoint, this company has become more and more profitable. It's definitely not the cheapest stock out there. If you look at just those metrics right here, price to sales 5 times. Okay, not the cheapest, but certainly growing quite quickly and deserves a premium. It also has a market cap of $2.55 billion. And so zooming out a little bit and seeing what has happened before and what's expected to happen further down the line, we can see, of course, explosive growth that started in 2022, followed by 2023, and then in 2024 still expected to grow quite quickly, and the same for the next 2 fiscal years, although growth rate should decelerate a little bit according to certain analysts. With regards to free cash flow, it's negative currently, but that's also expected to flip to free cash flow positive by fiscal 2025, and then, well, more than double the year after that. They generate revenue through 3 different things here. So United States, lung revenue, heart revenue, and liver revenue. Now, usually what would happen is that, well, it has grown quarter after quarter. This quarter, although, that did not happen. If you look at liver revenue, the biggest segment was basically down a little bit quarter over quarter. Heart down quarter over quarter as well, and lung the same thing. So that's also one of the main reasons why the stock is down so much. But in my opinion, this might just be a one-off thing. I don't think one quarter, one bad-ish quarter changes the whole thesis. But of course, if this continues, then yes, then it should be concerning. Now, they did give us a couple of things to work with during the earnings call, so they said the following. First, let me discuss the revenue and case volumes. In Q3, overall US national liver and heart transplant volumes declined sequentially approximately 5%, while total lung volumes declined approximately 3% in the United States. There's no clear reason for these declines other than normal variability of donor availability and potential summer seasonality. So the sequential decline in the United States case volume was directly in line with the decline in national transplant volume. Importantly, we did not see any degradation of our market share or central penetration on all 3 organs, which, okay, is good information to get, but I would like to raise, let's say, a question here is, okay, you did not lose market share, but why didn't you not gain any either? Continuing here, as discussed last quarter, while OUS was a very small portion of our business, we expected this international revenue to decline sequentially as we had some stocking orders in Q1 and Q2 that we knew were not going to recur in Q3. We also pointed out that lung revenue was not yet on a growth trajectory, so both of these were headwinds as expected. And the other driver of sequential decline was the overall decline in US transplant from Q2 to Q3, and our performance reflected this. So okay, fine, an explanation for the quarter. Let's hope that the next one does not need the same explanation. Now overall for this quarter, what did we get? Revenue increased 64% year over year. Cost of revenue increased 84.7% year over year. And so gross profit increased 50% year over year. Now, with regards to margins, you can see here margins are down from 61% to 56%. That's because service revenue took a bigger piece of the pie, and that's a lower margin side. So we're down here on gross margin. With regards to total operating expenses, you can see here, okay, that's great. It's less than a year ago, but a year ago we had a $27.2 million non-recurring expense. So if you remove that, then we would have increased year over year, the big increase here in SG&A. And then with regards to net income, well, same quarter last year was a loss, and now we are net income positive. As for full year guidance, still reiterating that, so between $425 to $445 million. Now we already know that from Q1 to Q3, that's a mistake here, that should be Q3, we have seen revenue of $320 million, which means that for Q4, we should expect revenue to come between $105 and $125 million. 105 is not good enough because that would be a quarter over decline again. 125 would be much better. Couple of comments here from the CEO. We are proud of our performance year to date and look forward to ending 2024 on a strong note. We continued to make meaningful progress across each of our growth initiatives through the third quarter and maintain our conviction in our growth runway for 2025 and beyond. Overall, we remain well on track to reach our stated target of achieving 10,000 OCS transplant cases per year in the United States by 2028, which would mean that they would generate around $1 billion in revenue. As mentioned, they currently operate a fleet of 18 dedicated jets, but only 10 were available for operations in Q3, and they will increase the fleet to 20 to 22 by the end of Q1. So of course, this is an investment phase for them, but being vertically integrated, not having to rely on third parties, is going to be very, very beneficiary for the company in the long run. And so a quick reminder. 1, this is the only FDA-approved multi-organ technology platform at the moment. So you've got all of those three right here: OCS lung, heart, and liver. With regards to the potential, the opportunity here, we can see here total deceased donors in 2023, over 16,000. And then if you look at the lung transplant, heart transplant, and liver transplant, I mean, there is huge opportunities ahead. As for the volume growth, in calendar year 2022, that was approximately 1,000. Then in calendar year 2023, just over 2,200. And then for calendar year 2024, they still expect to be at between 3,500 and 4,000. So of course, this company is still growing, and well, the goal here is still 10,000 a year by 2028. Looking at the charts real quick, what can we see? Well, still negative momentum. We're a bit in no man's land. Maybe it could rebound around $70. That's what it rebounded on back here in March of 2024. That could also mean that RSI is going to be oversold on the weekly. So currently I would say it's about catching falling knives right now. But I think dollar cost averaging in this one could be the play if, of course, you are bullish on the long-term potential of this company. So overall, to conclude, I don't think that a bad quarter is a thesis changer. I think there is a lot of opportunities in the stock market right now with these types of companies that have been performing quite well, but maybe expectations were sky high. A small miss here and there, and the stock gets punished. We're going to cover more and more of those companies because, well, let's face it, stock markets, it's at all-time highs or close to. Lots of companies are expensive, overvalued right now, and also are at all-time highs. So maybe it's worth looking at some beaten down stocks going into 2025. And I think Transmedics could be one of those companies. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.